10 things about SRI that you might not have known. So, the definition: SRI involves choosing investments based on ethical, social, and environmental criteria, in addition to financial return. ESG investing focuses on environmental, social, and governance factors that can affect investments' risk and return. Number two, growth. Sustainable investing is fairly mainstream these days. 95% of millennials, according to a recent survey, are interested in SRI. 86% of people believe that companies leading in sustainable practices are better long-term investments. Global markets for ESG and SRI investing have grown significantly in recent years for individuals and institutional investors alike. Number three, performance. There's numerous studies and analysis over the past decade that have shown that SRI and ESG investing can match or exceed the performance of conventional investments. This contradicts what they used to think, that you're giving up some return for looking at environmental, social, governance criteria. It's just more information. ESG criteria often identify companies that are well managed, forward thinking, and resilient to various risks like climate change. Companies that score high on ESG metrics are often have strong operational performance. They tend to be efficient, lower costs associated with environmental impacts, labor disputes, better management practices. These factors can contribute to positively, they can contribute to financial performance. All right, number four, diversity of strategies. ESG and SRI investing encompasses a wide range of strategies. So the oldest strategy was negative screening, just avoiding companies that you don't want in your portfolio. It's limiting the investment universe based on ethical considerations. Common exclusions are fossil fuels, tobacco, firearms, gambling. This approach aligns with investors' values, but can limit your options, and it doesn't necessarily make an impact making these, if you're quietly excluding on the secondary market. So, negative screening, positive screening is including companies that demonstrate positive ESG performance or adhere to certain social environmental criteria. This may focus on leaders and sustainable practices within an industry. So it can help screen, it can help include companies. A third one is thematic investing. So this strategy is where you're taking a specific ESG theme or issue, like renewable energy or clean technology or gender diversity, and you're including that theme and engaging in that theme. You're contributing to companies, you're screening based on that theme. Another one is impact investing. So instead of screening or including or excluding, making an impact on the companies in your portfolio. So it may, like engine number one does, don't even screen, just take the S&P 500, but make an impact with the companies you have. They want to generate, or these funds generally want to generate, measurable, beneficial social or environmental impact alongside financial returns. These investments are often made in private markets. They can include areas like affordable housing, sustainable agriculture, microfinance, but it can be broader themes of the environment. ESG integration involves explicit inclusion of ESG factors into your traditional financial analysis. So you're not necessarily excluding sectors, but you're just looking at it in the decision-making process of what to include or exclude. Shareholder advocacy. Investors using their powers of shareholders. You're a part owner, you have a vote. You can engage in dialogue with management. You can file or vote on shareholder resolutions. You can collaborate with other investors. And you meaning if you're a stockholder, the shareholder, but if you're in a fund, the fund management will do this engagement. Community investing. This is a strategy to direct capital to communities that are underserved by traditional financial institutions. You can support local economic development, investing in things like community development banks, credit unions, affordable housing, small business development. There's ways to get involved in and allow capital to flow into these communities. Blended strategies, many investors combine SRA and ESG strategies that align with their goals. An example is they might have negative screening to avoid certain activities, seek out companies with positive screening, might want impact and engage with shareholder advocacy, and might want community investing as well. Sustainably linked investments. Innovative financial instruments to achieve specific ESG outcomes, sustainably linked bonds or loans. Interest rates may vary, depend on the issuer's objectives. Another thing that's out there, another investment option, green bonds, social bonds, fixed income loans earmarked for raising money for climate, environmental projects or social projects. It's an opportunity to fund specific initiatives. The diversity of strategies has grown greatly over the last decade. It allows investors with different risk tolerances, different priorities, different philosophies to engage in SRI investing. Number 5, risk management. There are many investors who turn to ESG investing as a way to manage risk, believing that companies with strong environmental, social governance practices are better positioned to handle long-term challenges. So investing sustainably reduces risks. Numerous risks point to long-term benefits of sustainable investing. ESG factors are increasingly recognized as material to financial performance. Companies with strong governance structure, for example, are often less risky, while those that proactively manage environmental and social issues can avoid cost and liabilities associated with these areas. These risk managements can lead to more sustainable, potentially higher performance. It's just another factor. 6, regulatory interests. So government and regulatory bodies around the world are increasingly focused on ESG issues, leading to more transparency and more reporting requirements by companies, enhanced disclosure requirements. In financial regulations are requiring companies to disclose, requiring, or there's pressure to be included in certain funds or to receive money to disclose information around these areas. So fiduciary duty in ESG, there's a growing recognition that's considering ESG factors part of a fiduciary duty, that you should know if there's risks as you're looking at what you're investing your client's money in. Risk management requirements, incentives for sustainable practices. There's, again, a push that ESG factors can be helping reduce risk. All right, number 7, investor demand. A growing number of investors are seeking ESG and socially responsible investing options, driven by a desire to align their investments with their values and contribute to a sustainable future. There's increased awareness among investors on how their money can impact these social and environmental issues. There's demographic shifts, younger generations, particularly millennials, Generation Z, Gen Z, who are increasingly entering the investment market, showing strong preference for investments that align with their values. A desire for impact. Investments are not just seeking financial returns, but they want their investments to contribute positively to society and the environment. There's a realization that investment decisions can be a powerful tool to drive social and environmental change. And as we mentioned before, risk considerations. ESG's factors are increasingly seen as material to financial performance. They're recognizing that practices are likely to be more ESG practices, if they have strong ESG practices, are more likely to be resilient and better positioned for long term success and can reduce investment risk. Regulatory environment, the involving regulatory environment around climate change, social governance, also drive investor demand. Availability of information. With more information and resources available on ESG and SRI investing, investors are better equipped to make informed decisions. And performance recognition. Again, this used to be a hindrance. Now it's an advantage. The recognition that SRI in ESG investing can perform as well, if not better, than traditional investments. Having more information is useful. Institutional investor influence. Large institutional investors, such as pension funds and endowments, are increasingly incorporating ESG factors in their investment criteria. And that influences the broader market. It trickles down to providing more for individual investors to choose from. Product availability. The financial industry is responding to this greater demand with a broader array of investment, SRI and ESG investment products. It makes them lower expense. There's different asset classes. There's a lot of different options out there. Social and peer influences, including sharing values and investment choices with communities and social networks, play a role in the increased demand for SRI and ESG options. All right, number 8, corporate response. Many corporations are responding to this trend by improving their ESG practices. They're recognizing the importance of these factors, and they make a difference in their reputation, investor relationships, and long-term success. Enhanced ESG reporting. Companies are increasingly recognizing the importance of transparency of their ESG practices. Adopting sustainable practices, corporations and are integrating sustainable practices in their operations. And this can include reducing carbon footprint, improving energy efficiency, minimizing waste, using sustainable materials. These are all helpful for their reputation and helpful to get investors on board. Socially responsible initiatives. Businesses are investing more in sustainable initiatives, such as community engagement, improved labor practices, ensuring fair supply chain. And these efforts not only respond to investor concern, but they're also aiming at improving their corporate reputation and customer loyalty. Governance reforms. So many companies are reforming their governance structures to increase transparency and accountability, enhancing board diversity, improving executive compensation structures, strengthening shareholder rights. Not with all companies, but some companies are making these moves. Initiatives or innovative products and services in response to investor interest in sustainability. Some companies are responding with more sustainable products, and even fabrication, even their carbon footprint. Strategic realignment, I'm going to leave that. Collaboration and partnership increasingly engagement in collaboration and partnerships is enhancing their SRI efforts. Working with NGOs, government bodies, other companies to address these complex sustainable challenges. Risk management, as we've said before, if you're recognizing these issues, social unrest, poor governance, climate change, that if you improve those areas you can reduce your risk: employee engagement, cultural change, in response to regulatory changes. I think these are all corporations' moves given this pressure to address environmental, social governance issues. Number 9, there's a variety of assets available for socially responsible investing. It's expanded significantly, wide range of options, including just stocks, mutual funds, exchange traded funds has really exploded. There's a lot of exchange traded funds out there that are based around environmental social governance. Fixed income securities, green bonds, social bonds, sustainability bonds, private equity, venture capital, real estate. There is sustainable real estate investing, community investing, a lot of options there, community development financial institutions, impact investing funds have grown where they're not just screening, they're engaging with companies to make real changes. Alternative investments, addressing forestry, agriculture. There are funds out there or alternative investment options out there. This expansion across a diverse category, across these diverse categories, offers investors the flexibility to build a diversified portfolio that not only aligns with their values, but meets their financial objectives, time horizon, risk tolerance. So as there become more options, it becomes easier to have a diversified SRI portfolio. And number 10, global impact. SRI and ESG investing are having a global impact. They're encouraging companies worldwide to improve practices in areas like environmental sustainability, social responsibility, and corporate governance. All right. Thank you very much for listening. You can check out our blog for more information. Check out our website. We're at AIOfinancial.com. I'm Bill Holliday. We do have a free SRI ebook. You can go to AIOfinancial.com/resources. We have a budget app free. We have a retirement planning app free. We have an SRI ebook and mini course there, video, to give you more information. If you need any support, you can set up a free meeting with us. Again, go to AIOfinancial.com. Thanks a lot. Take care.